Have you ever wondered how central banks quietly steer the massive ship of our economy, influencing everything from interest rates to how easily you can get a loan? Well, one of their most powerful and frequently used tools is something called open market operations. Through these operations, a central bank directly impacts the money supply by buying or selling government securities in the open market. The core mechanism is quite straightforward. When the central bank, such as the Federal Reserve in the United States, decides to increase the money supply, it initiates open market purchases. This means it buys government securities, like treasury bills, from commercial banks or other financial institutions in the open market. The central bank pays for these securities by crediting the reserve accounts that commercial banks hold with it. These newly added funds become excess reserves for the banks. With more reserves readily available, banks have a larger pool of money to lend out to businesses and consumers, which expands credit and, consequently, increases the overall money supply circulating in the economy. Conversely, if the central bank aims to decrease the money supply, perhaps to combat inflation, it conducts open market sales. In this scenario, the central bank sells government securities from its own portfolio to commercial banks. The banks pay for these securities by drawing down their reserve balances held at the central bank. This action effectively drains reserves from the banking system, reducing the amount of funds available for banks to lend. This reduction in available funds for lending tightens credit conditions and shrinks the money supply. This continuous and calculated process of buying and selling securities is the central bank's primary method to fine-tune the amount of money flowing through the financial system, thereby influencing its cost and availability to the broader economy. So, what does this mean in practical terms for the economy? If the central bank determines that economic activity needs a boost, it will embark on an open market purchase program. By injecting money into the banking system, it lowers short-term interest rates, making it more attractive and less expensive for businesses to borrow for investment and expansion, and for individuals to take out loans for purchases. This encourages greater spending and investment across the economy, fostering growth and potentially increasing employment. On the other hand, if there are signs of an overheating economy or rising inflation, the central bank will engage in open market sales. By withdrawing money from the system, it raises short-term interest rates. This makes borrowing more costly, which can discourage excessive spending and investment. The intention here is to cool down an economy that is growing too rapidly, thereby helping to bring inflation back within target levels. These daily operations are incredibly flexible, allowing the central bank to make precise adjustments to the financial environment as economic conditions evolve. A crucial aspect influenced by these open market operations is the federal funds rate. This is the benchmark interest rate that commercial banks charge each other for overnight loans of their excess reserves. When the central bank buys securities, increasing the overall supply of bank reserves, the supply of federal funds in the interbank market increases, which naturally puts downward pressure on the federal funds rate. Conversely, when the central bank sells securities, reducing bank reserves, the supply of federal funds decreases, causing the federal funds rate to rise. While the central bank does not directly set the federal funds rate, it targets a specific rate and uses open market operations to ensure the actual rate stays within that target range. These transactions primarily involve very short-term government debt instruments, often treasury bills, providing a highly liquid and efficient mechanism for achieving broad monetary policy objectives without directly dictating individual lending terms. Ultimately, open market operations serve as the central bank's primary lever for managing the liquidity in the banking system and influencing short-term interest rates. By strategically adjusting the money supply, central banks aim to foster stable economic growth, maintain full employment, and keep inflation in check, all while preserving the purchasing power of our currency. It is a powerful yet subtle instrument, constantly at work behind the scenes to balance the needs of a dynamic economy.